Greg, look at the JOLTS report today. What does that tell you, and what does it tell you about what we're going to hear on Friday from the Labor Department report?
I think we have to be careful with any report. The JOLTS report in particular, given the very low response rates. We did see that openings rose, but I would tend to look at hirings and the quits rate as better indicators of underlying strength in the labor market. Both of these are at or below their pre-pandemic level. So there is an ongoing easing of labor market trends. I think what we're seeing in the markets is really an adaptation to this higher cost of capital environment where the Fed is unlikely to cut rates in the near future. Yes, the odds of another rate increase have increased over the last few days, but I think the Fed is really done with its tightening cycle. We've heard from Williams, we've heard from Barr in terms of maintaining the current restrictive stance of monetary policy. That means that they're going to stay at these high rates for the foreseeable future. I think that's what we're starting to see in terms of market pricing, along with fiscal sustainability concerns. That is really the market paradigm that is shifting towards this higher cost of capital environment.
So if that's the case, Greg, what does that imply for Treasury yields? Are we going to see 5% right around the corner for the 10-year? And are we then going to see that sustained level of high rates for how long?
Well, I think for the foreseeable future is really the answer. We're going to be in this higher interest rate environment for the foreseeable future. We're not going to see the type of rapid rate cuts that the Fed has proceeded with in times of economic slowdowns, in prior times of economic slowdowns, especially as long as inflation remains too high for comfort. We know the Fed is adamant to getting inflation back down towards its target, towards its 2% target, and it's going to be willing to tolerate some pain in the form of slower consumer spending, slower business investment, and slower employment growth. As was said earlier, this is going to be a key element of the outlook. If we start to see a degradation in the state of the labor market, that is going to lead to a faster slowdown in consumer spending growth and a faster slowdown in inflation. Let's not forget one key point here. The tightening that we're seeing on the financial markets front in terms of financial conditions is doing some of the Fed's job. So the more tightening we get, especially on the long end of the interest rate curve, the less the Fed has to do in terms of tightening monetary policy. That's very important to keep in mind as we look on the horizon into 2024.